Welcome guys, it's Walter here, and you're here at the Naked Trading webinar. Great to have you here. If you have any questions, you can just pop them in the chat box, okay, at any time. It really doesn't matter. I'll try and get to them as I can. What we want to talk about today is how 3 ways to make your winners bigger. So what I've noticed, I've actually tested probably a few thousand traders at this stage, or right just under 1900, with my it's basically a personality test that I do for traders when I work with them, which is kind of the way I operate. I'm a psychologist by training. I used to teach little kids to think about their thinking, and if I would have gone into academia, that's what I probably would have ended up doing, is teaching little kids how to think about their thinking, which as it turns out is pretty close to trading. So it's quite a mind game, isn't it, when you start playing around with these systems and your emotions and things like that. Now what I found in my testing is that one of the big mistakes traders make, even if they understand what they're potentially getting into with their system, in other words, they understand the risk of ruin, they understand the drawdown, if they can get past that, the next big thing that happens is they often run into this problem where their losing trades are too big, or on the contrary, the other way to look at it is that their winning trades aren't big enough. Okay, so what we're going to do is we're going to talk about, this today. How do you make it so that your winning trades are in fact big enough? What can you do? And there's 3 things that you can do at the very minimum, and we're going to talk about all of those 3 things today. So does that sound good? Everyone cool with that? If that's good, then we're going to do it. We're going to go for it. So that's basically what today's session is all about. It's about making your trades bigger. Now, I have a question for you. If you, let's say that you, and I wrote an article about this, I think it was about 10 years ago now. Yeah, it would have been about 10 years ago that I wrote this article, and I think it was for Trading Markets or whatever. It doesn't matter. The point is, if you go to dinner, and if you're like me, my wife and I, we love going out to nice restaurants, right? And let's say you go to dinner and the food is absolutely abhorrent. You just don't like it. And the people who are serving you are, let's face it, they're just jerks. They're not very nice. They're not very pleasant. So the food's no good. The people are jerks. Then what are you going to do in the future? What are you going to do? Are you going to go to that restaurant again? Are you going to say, yeah, I'll come back tomorrow? I'll book next week. See you next weekend? No. In most cases, you'll never go again, and in many cases, you'll probably tell somebody, that restaurant sucks. There's no way I'm ever going to go there again. That's probably what you'll end up doing. Now, what's interesting, though, as traders, what we tend to do, or at least in the beginning, and I know I was guilty of this, when we have a trade, and the trade isn't going very well, what do we do? What do we do? Oftentimes we'll take another position. So we say, well, let's say that I'm long the pound Swiss. Okay, I want to go long the pound Swiss, and the pound Swiss is pulled back. All right, because I saw it broke this resistance level up here at 26.40. So I went long as it broke it, and then it pulled back. And now I'm thinking, well, I'll just go long again. if it was a buy up here, it's definitely a buy down here. So I'll just add to my position, right? Well, the problem with that, of course, is that when you're in a losing trade, you're just going to keep adding and keep digging yourself deeper and deeper into a hole. And that's kind of like going to a restaurant, hating the food, disliking the service, and deciding that you're going to go back there again, right? So if you take a trade, the trade stinks, you add to it, right? No. What most traders do is they do that, or at least in the beginning we do that, and we forget that it's so much more profitable and useful if you add to a winner. Now this is contrary to the way we're built. Most of us are built in a way where we don't want to add to a winner, because maybe it turns into a loser. If we add another position to a trade, it could turn into a loser, and then that way we've made a good trade bad. But the problem is, if you don't capitalize on your winning trades, here's a nice little divergence on our Euro Aussie. I was talking about that today in the private forum. Let me delete this stuff. So here's the thing. If you really want to turn a winning trade into a huge winner, The way to do it is to add more positions. So when you see the markets in a trend, when it's trending down, you can add to it. Now I'm going to talk about how you might do this. That's number one. So is there any pair that you guys want to use as an example? If there is, just type it in the chat box here. We'll use your market as an example here, because I don't want to play favorites, right? But so if you have a pair that you want to see, we can do it, and I'll show you how this works. The euro yen's probably not a good one. Probably right now, some of the best might be that Kiwi's killing me. Kiwi's come tantalizingly close to my profit target down here. New Zealand CAD. Okay, so let's say that you want to go long the New Zealand CAD. All right. So the question is, and if you don't know, the pink little candles here are bearish down candles, and the sort of dark blue or navy ones they're bullish, right? So as you can see here, it's been going up. All I really need for to add to a position is I need a reason to do so. Okay, so if I'm looking at this chart here, and what I'll do is I'll actually draw some support and resistance levels in here, and I'm going to go to the 4-hour chart just because it makes it easier for me to see these. If you don't use horizontal support and resistance, you may not be used to this, but this is how I see the charts. I use these levels to find where might the market make a move that I'd be interested in. It still has to print a repeatable pattern at these levels, but the first step for me is for the market to actually get to these levels. Okay, so based on that, that's what I would say are my these are my support and resistance levels for the New Zealand CAD 1-hour chart, right? Now, here's the thing. It's going up. It's cleared the local highs over here. In fact, not only did it clear these local highs over here, but one might argue that it's broken out of this big consolidation box here. It's been in this giant big consolidation box, and I'll make this a color that's easier for us to see, like yellow or something. But basically, not only has it taken out these highs over here, and it tried and then pulled back and then finally broke through. Not only has it done that, but it's broken out this consolidation box. So I might be looking to go long this pair. And if that's the case, what I really want to see here is a reason to buy. Now look at these zones that I've drawn up here. I've got 1, 2, 3, 4 levels where if the market clearly closes above those levels, I could go long in the hopes that this uptrend is going to continue. Now, is it going to go straight up? Unlikely. What's more likely to happen is it'll do what it's basically been doing, which is it'll make a really strong candle up, and then it'll kind of sag down and retrace, and make another strong candle up, sag down, strong candle up, sag down, strong candle up, sag down. So what I really want to see here is I want to see the market clearly close above 94.77. I could buy. I could put my stop loss below the swing low here, or if I want to be safe, before below the previous swing low down here. And then as it keeps going, and I can ratchet up my stop loss. So then next thing is, can it close above 95.13? If it closes above 95.13, I take another position, and I move my stop loss in the original position. I could move it to break even. I could move it to 50% of where it was. So let's say for example that I end up buying here at 94.84, and my stop loss is down here 43 pips away. Let's say 44 pips away, right? So I might move my stop to 22 pips from entry after I get another position up here. And if my first position, let's say that I'm taking 2 lots, maybe my second position I take 1 lot. Okay? So if I take 1 and maybe my stop loss on my 1 lot position up here at 95, let's call it 95.20, okay? If I take a 1 lot position up there, I can realistically, I can give it 22 pips of room, right? And it would be just like the original position. In other words, the risk hasn't changed, and yet I have more profit potential. Or I could move to break even here, and I could give this sucker 44 pips of room as a stop loss, And in that case, I've done the same thing, which is basically I've reduced my risk. Because now instead of having 44 pips times 2 lots of risk, I have 44 pips times 1 lot of risk. So if it comes back down and stops out that position, I'm only going to lose half of what I originally was risking. And then I can do that again. So then let's say the market gets up here and it closes clearly above 95.33. Closes up here at 95.37, 95.40. I'll take a position there. I can move the stop loss from my original position here to this level, and I can move the stop loss on the second position that I took up here to 22 pips away from the entry or break even or whatever, and keep ratcheting up. It's not rocket science. You've probably done this or thought of doing this before, but what this will do is a couple of things. And some of you are probably thinking, well, wait a minute, hold on, some things can go wrong here. We're going to get into that in a moment. Later on in the webinar, we're going to get into what might go wrong if you do this and how to kind of hedge against that. But for right now, the important thing to keep in mind is that this is a great way for me, if I had 2 lots on originally, and if this trade goes, let's say that the trade ends up going well and goes all the way to this here, 70 pips. So I make like essentially 140 pips, right? Well, I made 140 pips. That's great. Now, what happens if I get this other position here as well? 140 pips plus 50, and then I get the next position here as well, 140 pips plus 30, and 140 pips plus 50 and 3, that's 80, and it's another 80 pips, and then another 20 pips. So I end up making another 100 pips just by adding to it, and I'm not really adding to the risk. I can set myself up so that if it does retrace against me, the risk hasn't really gone away. Now, you might be saying, well, that sounds all great and everything, but what happens if I had a really good trade, I had 100 pips in my pocket, it retraces and stops me out, and I end up with less than I would have had, right? So I would have had 100 pips, but because I had those extra positions, I ended up with break even or just 20 pips or something like that. Again, we're going to talk about ways around that and how you might address that. But for right now, just know that, the reason why this is so uncomfortable for most traders is because it's a great way to increase your winners, to add more to it, to go to the restaurant you like and not the one you don't like. It seems so comfortable and so comforting to add to a losing trade when really what we should be doing is adding to a winner. All right? Now, so that's my number 1 tip, is trying to pyramid into these positions. And if you want, you can adjust your stops so that your risk is reduced or at break even or whatever. And there's lots of different ways to do it, but one of the simplest ways to do it is that your larger position is in the beginning, and then you add smaller positions as you go. And then another way to do it is have your larger position in the beginning, add smaller positions as you go, and then right before you get to your target, you can actually add a really huge position. Okay, so you've got, in other words, you've got a lot to play with. So let's say, what if your trade goes wrong? Yeah, so we're going to talk about this. I think there's a couple of different ways that it could go wrong here. Let's talk about this. All right. Number 1 is you could be in a good position that's making pips for you, and you end up getting out at a loser. It ends up being a loser. So you take one position and you move your stop to 50% of where it was. So you were risking 44 pips, now you're risking 22. You take your other position, which is half the size, and then it comes down and stops out the second position and the first position. So it goes wrong. It's bad, right? It's a bad trade. Again, I'm going to show you no, the risk is not the same as martingale, actually. So martingale is based on the gambler's fallacy, which is that there are dependencies in your results. Okay, and generally speaking, most trading systems, most gambling games, that is a false assumption, right? So again, remember what we're saying here with the gambler's fallacy is that because I've had X number of losers in a row, I'm more likely to have a winner, right? What I'm saying is, if I'm buying this pair right here, if I'm buying this pair right here, and if this pair is going to end up here later on in the future at some stage, it has to go through all of these lines to get there. That's what I'm saying. I'm saying if I buy here and I exit there, the market must go through here, here, and here, which are opportunities for me to add to my position. Okay? Again, if I have 44 pips of risk on position 1, and I'll write this out so everyone's really clear on this. And I hate to be pedantic, but sometimes it's difficult to get away from this. So if you have 44 pips and you're trading 2 lots, what is that? That's essentially 88 pips of risk, we'll call it, okay? So that's your overall risk. Now, that's position 1. Let's say that we get in position 2, okay? Now what happens if we move position 1 to break even? Okay? So if it comes back down and stops me out, it's going to stop me out at my entry price, okay? So that's got no risk anymore. Now, what if my second position, instead of being 1 lot with 40 or 2 lots with 44 pips of risk, it's 1 lot with 22 pips of risk, right? That equals 44 pips of risk, because I'm risking, sorry, it equals 22 pips of risk. 22 pips of risk, because I'm risking 22 pips. My stop is 22 pips away. I've got 1 lot on there, and it's 22 pips. So essentially, I'm risking a quarter of what I originally had on the trade. Now, if I get stopped out on the second position, I'm going to lose. Let's say that I was risking 1% on the first position right here, right? Which was originally right here. That's 1% risk. This is now 0.25% risk, or a quarter of a percent. Now, let's say that I do the same thing up here. When the market gets to the next stop, I'll take 22 pips of risk times 1 lot. So I'm risking 22 pips, okay? Now, if I move my stop loss, so that's the second position, which of course is at the next level right here. If I move my stop loss on the original position half, so instead of risking 22 pips, now I'm risking 11. Again, what am I risking here? I'm risking less than half of my original position. Okay, and not only that, but I've locked in some profit from my original position if I've moved the entire stop to 11 pips away from position 2. So you see how this works. What's happening now is I've locked in some profit from the first position, and I've mitigated risk on position 2 because I've reduced that risk in half. So instead of risking a quarter of a percent, I'm risking an eighth of a percent. But now, remember, I've got this other right here. So I'm risking a quarter of a percent on this third position, right? So I'm risking quarter of a percent, so plus 125, so what is that, 375 or whatever, plus I've got the profit to go with here. I've got profit already locked in here, which in this case, let's call it, it would have been something like 50 pips, right? So I've locked in 50 pips, and I've got 33 pips of risk. But remember, it's actually 50 pips times 2, so it's 100 pips. So all of a sudden, I'm already in the clear. Even if I get stopped out, I lose 33 pips here, but I've got 50 pips times 2. I've got 100 pips locked in, or whatever, 40 pips times 2 at 80 pips. Whatever, the point is, I've already locked in profit, and the same thing, I can do the exact same thing here. Now, what I will say is, and this is something for you to test in Forex Tester, what you may find is that your last position, this is how I like to do it, is I can add quite a bit to that last position. So this last position, it's really, really close. The reason why I can do that is because now I've moved my stop. So my stop loss, say on position 2, is now at nil, so it's at break even, right? So I'm risking nothing. And my stop loss on the third position is now at 11 pips, right? Something like that. So it's, again, it's at, 1/8 of a percent. And then this one's locked in. All of a sudden it's locked in, no longer 40 pips. It's locked in 60. It's locked in, 80 pips or something like that. 80 times 2 is 160. So if I got 160 minus 11, right? So that's 149 if I'm right. 149 pips I've locked in. So now, is it worth it for me to add this last position here? Let's say it's only going for 15 pips of profit, right? There's 15 pips of profit that this last position goes. So remember, I've got 149 pips of profit no matter what happens if the market totally reverses against me. So can I risk that? Could I risk that? I might. What I might do here is, what if I added 4 lots at the very end, okay? And if this 4 lot position had 22 pips of risk, that's 88 pips of risk, and I've already locked in 149 pips, right? So whatever that is, 149 and 100, I don't know, 79, 69, yeah. So I've got 69 pips, 61 pips. So I've got 61 pips of profit if this final lot gets stopped out. But if it doesn't get stopped out, and I make that last 15 pips times 4, that's another 60 pips of profit that it adds to it. So overall, it's a huge result. So this, just so you guys know, this is the way that you can take a 1% trade that originally risked 1%, and you can turn it into a 15% return, or a 20% return, or a 33% return by doing this. This is how you do it. Most people won't do it. It's uncomfortable. But the fact is, if the market is going to go from this spot right here where the first arrow is all the way up to our little thumb up here and go 112 pips, if it's going to do that, it's got to go through these levels. And there is a chance that it could go through these levels without totally, turning around. It might turn around and stop me out, and I might end up with a break even or a little loss or a little profit, but occasionally I'll go all the way through up to here. Does that make sense? Greetings, Sam. Greetings. Cool. So this is not the same risk as martingale, and the reason why is because martingale assumes that there's a dependency between your trades, right? There's a dependency between your trades. So, for example, if you have a system and you've had 7 losers in a row, and by the way, you can check and see what the likelihood of X number of losses in a row. I've got a calculator for you. If you guys want, there's a video that shows you how to use it. You can see what your drawdown might be. Just go to fxjake.com risk/risk, and the calculator will show you all this, okay? You can go through and figure out what kind of drawdown you want to avoid, what kind of likelihood it is that you have a certain type of drawdown, that sort of thing, given your risk parameters and your system parameters. But this is a really good way to find out, how to avoid a drawdown, is to run your numbers essentially. Yeah, I can show you a trade if you want to see a trade. Sure, no problem. Here, I'll show you a trade from last night. How's that sound? It sounds like some people are having problems believing this, which I guess is understandable. I don't really know. I don't know if this is going to show up on the screen. See if I can find it. Hold on, guys. One second. Let me see if I can find this for you, okay? What other questions do you have? Right. Okay. Yeah. Well, if your trading does, if you don't believe in trading this way, then I'm not assuming that you should. All I'm saying is that the reason why most, and I'll show you, you can see where most traders are. I'll show you. This is where most traders are. This is what most traders are doing right now. And I hope that I am sharing the screen. Yeah. There we go. So most traders right now are going long silver. Most traders lose. Most traders right now are shorting the Aussie. Most traders lose. What I like to do is, I have an order to short the Euro Swiss because most traders are going long. I'm on a trade to go long the Aussie because most traders are shorting it. This is how you find out where the money is, right? And in the same way, if most traders here have a problem adding to a winning trade, like I did last night and essentially made 39% on the risk of the trade, the reason why most traders have a difficulty doing that is because it's easier, it's more natural to take the losing way. The losing way is to do what? To add to a losing trade. That's the losing way. The losing way is to martingale your way out of a problem. Oh, I've got 5 losers, I'll just keep doubling my risk. That's essentially how it works, and that's what trading is all about. I don't think you should feel bad when you take money from traders who are doing crazy things like martingale, or crazy things like adding to a losing trade because if it was a good buy yesterday, it's even better buy today because it's down 80 pips. Those are the things that you shouldn't feel bad about. You shouldn't feel bad about staring and seeing what the crowd is doing and doing the opposite. If you look at most traders, what they're doing is really difficult for most people to keep doing over a long term. And things like this is one thing that you might do because it's difficult to do over a long term. It's difficult to keep adding to a position, hoping that it keeps moving, knowing that if it stops out, you're going to give some profit back and you're going to lose a little bit. So that's the first thing that I would encourage you to test. Don't take my word for it. Maybe it doesn't work for you. Maybe you don't like trading, for big wins. Maybe this isn't something for you. There's another way that you can improve your winners, and that is simply to go with the trend. What is the trend? What's the trend look like? Well, one thing that you might notice when the market starts moving is that it'll often set in a little spot where it rests. Like it'll make like a little box, and you'll know that it's in a box because the candles get really tiny. They'll often alternate up, down, and they don't really go anywhere. And then all of a sudden the market will go strong down for a little while, and then it'll rest again, or maybe go counter trend like it did here. So it'll kind of go against the trend and do a little up move, even though this trend is going down. And then it'll rest again, then it'll make another move down. This is the kind of thing that you will notice when you're in a trend. The easiest thing to see when you're in a trend is this. The candles get wicky, they get up, down, they don't move much. And here's another one right here. Then you see another strong move down. You'll see when it boxes up like this, or if it goes in my preference is for when it boxes up and just flat lines. I like those retracements better than when it goes up a little bit. It's okay if it goes up a little bit because you can still use the trend line breach. If it closes below the trend line, you can keep going short. But this is the kind of move that I really love to see in terms of, a quiet trend. I like to see the big candles and then the quiet ones, a little flat line, and then the big candles like that. And you'll see this across the board. It'll go in one direction, it'll go flat, quiet, it'll go in one direction, it'll go counter, it'll go down, or in one direction, it'll flat, one direction, flat, one direction, so forth. Cool. Is this strategy based on Elliott waves? No. Nope. No, it's not based on Elliott waves. It's just based on common sense, which is basically, look, when you're in a trend, now when you're not in a trend, all bets are off, right? Because your up candles are going to be about as strong as your down candles. And you could probably argue that somewhere around this spot right here, we kind of went, okay, now we're in a directionless market, right? In this big box right here. I would argue that, yeah, now we're not really, you wouldn't really say that you're in a trend, okay? In this blue box. The trend was over there. Because what's happening now is the up moves and the down moves are a little bit more symmetrical. When you're in a trend, you're going to see really strong trend candles that will go much further, much faster than the retracement candles, which won't go very far and won't go very quickly. The retracement candles can go against the trend, as we have in this little green channel, or they can just flatline. My preference is for them to flatline and box up, but they can also go against you. I like low volatility, quiet trends. Those are my favorite. Yeah, well, I talked about the euro yen this morning. I don't know if you saw the video this morning. The best thing this can do to confirm is to break higher now. It didn't go higher during Asia. It went lower, which is great. That's a good sign. But it's got to break now. Between now and say 2 p.m. New York time, it's got to break. And what's a break? The high of the kangaroo tail is at 119.87, so it needs to get to 119.95. 119.95 to confirm, and then we could go long. Yep, absolutely. But until it does that, it's not a confirmed kangaroo tail. It's done everything right. It's gone lower during Asia, which is good. That's really good. It's gone about as low as it did over here. It's all very symmetrical and looking brilliant, but it still has to break higher than the 119.87 high yesterday, because today's high didn't take out yesterday's high. So it needs to go to about 119.95, and then I'll get interested in it. So all right, so the first thing you can do to make your winners bigger is you can add to your winners. You can make them bigger by adding to them, by adding multiple positions as you get closer and closer to your profit target. I would test that out and make sure that you can make it work. The key here is to manage your risk smartly. Number two, another way to make your winners bigger is to simply trade with the trend. It's kind of like cheating. You know why stock traders, as a rule, stock traders are generally smarter than us, guys, okay? As a rule, Forex traders, not so smart. It's just a fact. They tend to be older, more educated, and they're just smarter guys in general. But there's the number one reason why I think stock traders are even smarter, and that's because they trade in stocks. Okay, in share markets, it's often illegal to short certain companies or at certain times or whatever. In other words, it's a stacked game. The game is to go up. The game isn't to go down. And if you look at things like the S&P 500, you'll see and this is what you'll notice. Go to the S&P and have a look. When you're looking at the S&P, you will often find it's really, really difficult to pick the tops in the market. You know why that is? Because it's always going up. You know, it's always going up. The market is always going up. It's really difficult to pick the top. It's really hard to know, because what happens is people look at it and they go, okay, all right, that's the top, that's it, it's gonna roll over. Nope. Okay, that's it. Nope. Okay, we found the top, it's gonna, nope. oh, here it is, it's rolling over and it's over. Nope. Oh, here it is, it's definitely making a lower high than the high over here. It's over. Nope, and it's back up again. So what we need to keep in mind here is that these guys are smarter than us, because they're trading a game where it's much easier for stocks to go higher. It's much easier for indices like the S&P 500, which we're looking at right here, to go higher. Now, most of us, depending on where you're at as you're watching this recording, If you're in the US, then bad luck for you. But if you're in other places around the world, you can usually trade CFDs, which means that you can trade indices even on your Forex account. So that's great. And what's great about it is you can use these same trend trading techniques that we've been talking about, right? And you can use them in indices, and you can see, okay, well, where's the trend candles? Well, the trend candles are the ones that go about as far as it takes, you know, 8 counter trend candles to go. So you get these big trend candles, and you get these counter trend moves, and then you get the big trends, and then you get counter trend moves. So all you really have to do is you wait for the market to break out of the counter trend room. Now, I would actually argue that that one is not. This would be a box right there, and we're currently in a box right now on the S&P. So if you wanted to do some trend trading, you would wait for a breakout above the recent high over here to the left, 23.62, 65. Now, the other way to do it is when you get these saggy retracements, you wait for it to breach the trend line, which would have been this candle right here. Let me zoom in so you can see this. So it's this candle right here. So this is an example of what a beautiful trend looks like. Beautiful trend, you can often find them in the share markets. Now, the charts are a little bit gappy. They're not as smooth as Forex and all that, which I don't really like. But the fact is that it is a stacked deck against shorting. Now, you'll find these big short moves in the, you'll see these big stabs lower in the market, but you'll notice that it usually bounces right back up almost immediately in most conditions, and it'll just stab right back up. So those are often the best opportunities in these markets. But right now, you can see this is exactly what we're talking about. A volatile trend candle, then little tiny candles that don't go anywhere, then a volatile trend candle, little tiny candles. So you wait for the market to do what? You wait for it to breach the top of the box or to break out and close above the trend line. All right, and obviously for a downtrend, it's the reverse. I think I've already shown you that. Cool, you guys all cool on that? All right, last thing I want to show you is something that one of my students showed me. He's an amazing trader. He's a really good trader, and this is something that people will probably argue just like adding to a winning trade, but I want to share this with you. Okay, what you might do when you have a trade, let's say that we're going, let's say that you're going, let's say, what's a good, well, I guess the S&P is probably a good one. Okay, so here's what we could say. Let's say that we're going long the S&P when it breaks and above, it trades above 23.6620. Okay, so I've got my line here. I got my line in the sand. As soon as the market gets up there, let's say 23.6577, it breaks above there, I'm going long, right? Now the question is, how do I get out of the trade? What do I do? Well, what my friend taught me, which is pretty cool, is you can do a couple of things. Let's say you're risking 2% per trade, right? That's what your risk parameters are. You've worked out your risk of ruin, and you know what kind of drawdown you're trying to avoid with your system parameters. You know what your average winner is, your average loser, and your win rate, so you can work all that out. You can avoid the drawdown. Let's say you're trying to avoid a 25% drawdown. So you've worked it out that you can risk 2% per trade, okay? Now what ends up happening here is you can split it up into 0.5%. And the first 0.5%, you might have a simple 1-to-1 reward to risk ratio, okay? So that would just be a 1-to-1 target. So if you're risking, $3 on the trade, your reward is $3, okay? So that would be the first half a percentage. So in other words, instead of just taking one position that has 2% risk, you split it up into 4 positions, okay? The next 0.5% risk, you go with something a little bit more aggressive, okay? And in this one, you go with a 2-to-1 target. So these are hard targets. They're put in the platform, whatever your platform is, and you just go for it, right? So you got a 1-to-1, you got a 2-to-1, and in the next one, And if you've never, you should definitely test this. I challenge you, if you're watching this recording, I challenge you to test this. My friend James taught me this, and it's a wonderful way to see. You're trying to cover all your bases instead of being a runner or a gunner. A runner is a person who likes to use a trailing exit. A gunner likes to use a target, get in and out. What you can do here is, I'm going to put all these up there so that they're all, okay. Now you've got your 1-to-1 target, your 2-to-1 target. You've got now on this one, you've got your trailing exit. Now I'm not going to suggest, well, I like the 3-bar exit, but you can use whatever you want. And then finally, you use your pyramid. So I like the risk-free pyramid, which is what we were talking about earlier at the beginning of this session. So, because you never know if that one's going to hit, and they don't always hit. But does everyone understand why that would make sense? So if I had a 2% trade, 2% risk, and I just did a 1-to-1 on my 2%, I might get really upset if I saw it take off and go, 5-to-1. Whereas that trailing exit, if I had a trailing exit, I would have captured that. And one of the problems that we have as traders is we're always trading the last trade. We're always saying, oh, wait, hang on, hold on a second. Well, last trade, if I used a trailing exit, I would have made a lot of money instead of a target. So next trade, I'm going to use a trailing exit. And what happens? You use a trailing exit and you give back, a third of your profit. And if you would have used a target, you would have made more money. So the beauty of this is, in a way, you're almost always right. Obviously, you can get stopped out. You can lose all of it. But that's the same with any trade that you're risking 2%. But if it's a winner, the lowest bar for it to hit is the 1-to-1. That's the easiest one. And if it goes a little bit further, it'll hit 2-to-1. That's really great. Now sometimes your trailing exit will win and beat the 2-to-1, but oftentimes the 2-to-1 might beat your trailing exit. Sometimes your 1-to-1's going to hit, your 2-to-1's going to get hit, your trailing exit makes really good money, better than the 2-to-1, but it didn't go fast enough or far enough to cash you out with your risk-free pyramid, right? So you're happy because maybe your trailing exit made 3-to-1, this one made 2-to-1, that one made 1-to-1. So all up, you made 3 to 6, so an average 6 to, it's average of 2-to-1 basically, right, on that one. But if you hit your risk-free pyramid, you could be risking 0.5% and you make 7.5%, right, if that one hits. So this is something that I would encourage you to test. It's painful, yes, but it makes a lot of sense because you never know if the trailing exit is going to be happy with this trade, or the targets are going to be happy, or if you're really going to see some acceleration, in which case, if it accelerates to your target, the risk-free pyramid might work out as well. Are there any questions about that? Does that make sense? So those are the 3 ways that I would encourage you to use, 3 things to test. 1 is test the pyramid strategy. 2 is to test trading just trends and waiting for those simple naked trends like this to appear. 3 is to split your positions up like this so that you have multiple different ways of cashing out. A 1-to-1, a 2-to-1, a trailing exit, and a risk-free pyramid. Are there any other questions about any of the charts or anything like that? I know we're almost out of time, guys. Yeah, we're definitely winding down. All right, cool. Well, I thank you for your time. I really appreciate it. I hope you guys have a wonderful trading week, and we shall see you soon. Thanks, guys, for your time. I really appreciate it, and we'll see you next time. Take care.